Hi, Martin Turner here. This week, Maria Tyler leads our lecture as we look at non-current assets and depreciation. Maria introduces us to what non-current assets are, assets expected to generate economic benefits over more than 1 year. We then look at what can often be a major part of our firm's non-current assets, property, plant and equipment. And we first record property, plant and equipment at cost. And we are introduced to depreciation and the straight line, diminishing balance and units of production methods. Let's start by looking at what non-current assets are.
Good morning to everybody else. I assume that everybody can see me and hear me as well. I have to apologise, there are a couple little typos in my slides today, which I just noticed as I opened them up and quickly reviewed them this morning. So the first one is the unit name on the slides. So you're not in the wrong unit, it's me. I apologise. It is 11081, Introductory Financial Accounting, so just ignore the slide names up here. So this week we're looking at non-current assets and depreciation, which is one of the steps that you'll have to complete as part of your assignment. So stay tuned. And again, I apologise because it is going to be a little bit more traditional in terms of lecturing today. I'm literally going to shove a whole heap of information at you and hopefully you'll take it away for your workshops and be able to process it and make it a little bit more of your own as you look at your own companies. So the first style may be a little bit just traditionally lecturing to you. I do have a fair bit of information to get through. So we'll run through non-current assets in general. In particular, I focus on property, plant and equipment because for a lot of companies that is the largest expense. We'll cover depreciation because you need to know that when you're writing in your assignment. That's specifically what we ask you to focus on. But of course, depreciation being the key concept, you can then relate other concepts surrounding non-current assets into your discussions. And we really like to read how students do that. Very, very, very briefly at the end of the lecture, which is probably going to be the section you forget because I'll have given you so much information already, I am just going to touch on impairment intangibles and revaluation. Then we will look at step 10 of the assignment, which is related to this week's content, and we'll finish off with the minute paper. Now, I do want to make a special mention of the study guide chapter because the format of this lecture is very much aligned to the study guide. So as you're going through, you'll probably find there's a lot of similarities through that. Chapter 5 is the chapter that you need to be referring to. That's the dual chapter on receivables as well as non-current assets. Okay, so if I just quickly flick to chapter 5 of the study guide, you'll see it starts off with property, plant and equipment. So just to prelude to that, we're just going to discuss what is a non-current asset. And this really brings us back to the conceptual framework in accounting, which we began our journey in the prerequisite unit, ACCT 11059, Accounting, Learning and Online Communication. So if you cast your mind back to the foundations that we set there, the distinguishing comments or concepts between current and non-current. So current being within 12 months and non-current being a time beyond 12 months. And we looked at that distinguishing between current and non-current in terms of assets as well as liabilities. So current asset, hopefully something that gives us future economic benefits within 12 months. Non-current asset, one that hopefully gives us benefits in a longer period than 12 months. And again, with the liability, similar thing. Current being, we will have to pay that obligation within 12 months, and a non-current liability being something that we'll have to pay on an ongoing time period beyond 12 months. So the distinguishment between current and non-current is the same. We're looking at the non-current assets now. So the assets which are going to generate economic benefits for more than that 12-month period, more than that 1 year period. So some of the common examples, property, plant and equipment. And we always get a question, what on earth is plant or plant, whichever way you want to pronounce it. And I've covered that on the next slide. Intangible assets are often a large portion of your particular firm's non-current assets, and then different types of investments as well. They're the very common examples. And we're going to go to your companies now and have a look. So if you've got your annual reports in front of you, or you know where you can find them quickly, if you can just hop into them now, just open the latest annual report and go to the balance sheet or the statement of financial position, because on the next couple of slides I'll get you to bring up your own firm's balance sheet and have a look at the non-current assets. You will have to do this for step 10 of the assignment. So opening it up now just means it's going to save you time in the workshop. So, and I'll show you Wesfarmers as well. So there are common types. So we have a look at your firm's balance sheet. So open them up. I will minimise this and flick to Wesfarmers. I have it all ready to go. So I've just opened up their 2018 annual report and their financial statements, straight to the balance sheet. Scroll down to where they have non-current assets. Depending on which country your firm's domiciled, which country's accounting principles they follow, your non-current assets might be at the top. Okay, so with Wesfarmers, they're an Australian company, and we list our items on our balance sheet in order of liquidity, according with the Australian accounting standards. So my non-current assets are underneath my current assets, and they've actually got a nice heading for me. What I'd like you to do with your firms is just have a look at the largest three. Okay, what are your largest three non-current assets? So for Wesfarmers, so I can have a look at what Wesfarmers has got. So they've got investments in associates and joint ventures. They've got deferred tax assets, property, and they've got plant and equipment, goodwill, intangible assets, derivatives, and they have a very small amount of other, which doesn't fit into any of these previous classifications. So if I look to the figures now, and I'm just going to look just for the 2018 financial year, okay, so I'm just looking at the grade figures. I'll just have a look at the largest three figures, and immediately this one stands out, which for Wesfarmers is goodwill. We'll look at what goodwill is and the common understandings of goodwill right at the end of today. That's their largest. Their second largest is actually their plant and equipment. And if we combined the property with the plant and equipment, it becomes more so their second largest non-current asset. So 6488.
You are in the Zoom meeting now.
Good morning, Emily. I can see you on Zoom. Morning to everybody on Zoom. Sorry I can't zoom in to see who's on there. It just gives a lot of feedback for the lecture, so I just have to live with seeing every now and then you flash up on the screen. And if I look at Wesfarmers' third largest non-current asset, it is their intangible assets, which again we'll look at towards the end of today's lecture. Okay, so goodwill is, for Wesfarmers, is their largest non-current asset, and it's their largest by a lot. If you look at the figures for the others, they don't really even remotely come near it. So goodwill, then property, plant and equipment, and then intangible assets. They're the largest three for Wesfarmers. Now your companies will be different to that. Your company's largest asset may be the property, plant and equipment. So we're going to focus on property, plant and equipment in the first section of today. It is generally one of the largest non-current assets on the balance sheet. So sometimes they're called, instead of property, plant and equipment, they're called tangible fixed assets, or other names. They can be called a whole host of different names, but the more common names, property, plant and equipment, and tangible assets, tangible fixed assets. Basically, they're any asset that has something physical. It's a physical substance. You can physically go and touch them or see them. So it's any asset with a physical substance which we hope, or we expect, will provide us with future economic benefits for more than the 12-month period or more than the year. Most of our property, plant and equipment items will be depreciable, which means we will allocate their cost over their useful life to the business. And we need to look at those terms in particular. These are all the key concepts we expect you to discuss back to us as part of step 10. So what is depreciation? What is it? What are the common conceptions of it or misconceptions of it? And what is it really in accounting? Okay, so we record our property, plant and equipment initially at cost, which we term historical cost because eventually it does become quite historical. And we look at processes, you know, if a asset that we purchased many, many years ago actually at its historical cost is at a different value today, we actually have an option to revalue that. And we'll look at the revaluation model next. But initially, we record it at cost on our balance sheet. Okay, now one of the common questions we get is what is plant? So we see property, plant and equipment. Most people know generally or have an idea about what property is, and most people have an idea about equipment, but what is plant? So plant is a traditional term that was used for manufacturing processes. Okay, so it's a physical building where different forms of the manufacturing process occur, and they called that a plant. So that's where the term originates from. So property, plant and equipment. Now, this is a very basic and detailed view of, this is the disclosure on the balance sheet. So I just want to point it out, and I will refer back to it in another slide later. But generally, on the balance sheet, under non-current assets, you will see some sort of disclosure similar to this. So property, plant and equipment, we've got land here at its cost. We have buildings here also at its cost, and we have equipment here also at its cost. Now, there's two extra lines. There's less accumulated depreciation and less accumulated depreciation. So one for the buildings and one for the equipment. And we'll go through, and that's what we call a contra asset. So accumulated depreciation is what we call a contra asset. And what is accumulated depreciation? It's the accumulation of the depreciation over a number of years. So every year we depreciate our particular asset, and then that year's depreciation gets added onto the next year's depreciation, which gets added onto the next year's depreciation, and so the depreciation is accumulated in the contra asset account on the balance sheet. And we'll look at the journal entries next. Okay, so the accounting standard that covers property, plant and equipment is AASB 116. Now in paragraph 16, and rather than read it out on my slide, I'm going to go to the study guide because I'd like you to refer back to this. And you can actually go and read the standard itself. Remember, aasb.gov.au, table of standards, and scroll down till you see AASB 116. So in the study guide, Martin has written so there's a nice introduction about what is property, plant and equipment, and then the cost of acquisition. Okay, so property, plant and equipment comprises these three attributes when we record it onto our financial statements. Okay, so we've got the cost of an item is its purchase price, including import duties, non-refundable purchase taxes, after deducting trade discounts and rebates. So that's the first portion of cost that we include. The next portion is any costs directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by management. So anything to bring the asset in and make it ready for use, as well as, this is often overlooked, the initial estimate of the costs of dismantling and removing the item and restoring the site on which it is located, the obligation for which an entity incurs either when the item is acquired or as a consequence of having used the item during a particular period for purposes other than to produce inventories during the period. So the cost of dismantling, removing and restoring the site to an original condition can often be overlooked, and it can actually amount to quite a large amount of money to be included when you think about things such as mining, where they actually have substantial amounts to restore after the asset is used on a particular site. So I just wanted to point that out. It's not just the purchase price. Okay, when we record an asset at cost on the balance sheet, sounds like a fairly simple concept, but in reality it can be a little bit more complex. So there's these three attributes that we need to consider when we're putting the cost onto our balance sheet. So when you're looking at your firms and you're looking at their property and their plant and equipment, and you're looking at these values, remember that those values were originally recorded at cost, which included all of those three items, the purchase price, plus any other expenses or costs to make it ready for its use, plus an estimate of the cost for dismantling, removing and restoring the site to an original condition. Okay, so they're the three components according to the standard. Okay, so for an example, what is the cost of property, plant, equipment? You have the list price, so that was the purchase price of a particular machine. They were given a trade discount, so they didn't have to pay that amount, so we take it off the list price or the original ticket price, which brings it down to a new amount to pay. Now, we don't record our assets inclusive of GST. Remember, we include them net of GST because the GST is taken out and placed in the GST collected account on our balance sheet. So the GST we take out, we put it into the GST account, which we can then claim back as our refund from the tax office. So we take this out, so we don't include it as the cost of the non-current assets, so take it off again. So that then brings the purchase price to $45,000. Now, we had to also pay some installation costs. So net of GST again, we don't record the GST in the assets. So the purchase price, add on the installation costs. So the final cost that we will put on our balance sheet under property, plant and equipment for this machine is $46,700. Okay, so that's just a very simple example. So you may actually have to show the steps of how you arrived at that particular cost that you've put on your balance sheet, particularly if your entity is an audited entity. Always keep your workings. Okay, so that's essentially a very, very broad overview of pages 5, 6, and a little bit on page 7 of the study guide. So the non-current assets portion of chapter 5 of the study guide starts on page 5. So just remember 5. Chapter 5, page 5 is where we started. So now we're going to cover depreciation. Now this is the particular key concept we've chosen or we've asked you to focus on for step 10. But of course, depreciation is related to all the other concepts we've discussed today, as well as some other concepts we won't discuss today. And you're able to bring in whatever key concepts you like in order to help your explanations surrounding depreciation in your assignment. So we're starting on page 7 of the study guide. We're going to cover quite a lot of aspects of depreciation. So I normally put in a slide where I ask for you to comment on what your thoughts of depreciation is. But we haven't had a large amount of responses lately, so I thought I might just air it out and ask you to verbally tell me what your understanding of depreciation is. So there's no right and wrong answers. Just want to hear that people are there, that you're listening to me and engaging with me. So anyone would like to offer their view of what depreciation is?
Also, for emergency after hours, 2 days in a row.
You're not real good. You're not real good shape.
I can see Bundabergs. Come on, Bundaberg. Give me what you got.
They hit me with this pill that they give to people with broken bones.
They're a bit shy, Maria.
That's all right. You can be their spokesperson, John. I do it for my students.
Okay. Well, the transaction that we recorded was an asset in the balance sheet, but that asset gets used up over time. And depreciation is a method, accounting method we use to recognise that that asset is being used up over time. And it's all part of the matching principle of matching expenses with the revenue. And I think it's not a big stretch of our imagination to understand that as we use an asset up, that asset is actually being used to generate revenue and profits. And so it's really very much core to the concept of the matching principle.
Yeah, thanks, John. I don't have to read my slide out now. That's pretty much everything I had on my slide. Normally, I want to say hello to Kelly too on Zoom. You popped up before and I saw you listening there, which is good. So most people, if I had Maitland here, I don't have Maitland here today, he would definitely give me his view. But most people will say depreciation is something like the wear and tear of an asset. Or, my car depreciates. I drive it out of the showroom. I bought a new car and I drove it out of the showroom and it depreciated by $8,000 just like that the next day. So most people have a concept of depreciation that it's the wear and tear of a physical asset. And that's generally what I find when we're talking about, or if you talk in general conversation with people. My hubby still thinks it's the wear and tear, it's my assets depreciating. So that's fine. That is an understanding of depreciation. And it is meant to, the accounting version of depreciation, I guess, is meant to try and match the physical wear and tear. But it doesn't, because the accounting concept of depreciation is exactly what John just said. It's simply an accounting journal entry. It doesn't match reality at all. We'd like to think that it does, and there are methods that we can try and use to try and match what happens in reality. But the accounting reality of depreciation is it's just a journal entry with an estimate, some accountant's estimate of what's the cost that we've used in helping to generate our revenues this period. That amount of cost, we're going to turn it from an asset to an expense, and we adhere to the matching principle. Again, so the matching principle John mentioned is central to the concept of depreciation. It's got nothing to do with wear and tear of an asset. Depreciation in accounting is simply adhering to that matching principle that we learned about when we looked at our conceptual framework of accounting. So the conceptual framework of accounting talked about how every period we generate some revenues, and we have to try and match all of the expenses that help to generate those revenues in that same period. So if we've used up electricity in helping to generate our sales, even though we haven't got the electricity bill yet, it's coming in the next quarter, we have to estimate the amount of electricity we think we used out of that next bill and then journal that in. So that's what depreciation is. We have to estimate the amount of the asset that we think we've used up this period in helping to generate our revenues and journal that into this period. Okay, so we are matching our expenses with the revenues that we think they've helped to generate. Okay, so the matching principle is core to the concept of depreciation. So it's non-cash. There's nothing cash about depreciation. It's one of the largest non-cash items, and I do cover this actually in week 10 when I cover the cash flow statement. One of the methods of the cash flow statement is a note reconciling the operating cash flow to profit. And one of the non-cash items in that reconciliation is depreciation. So it's non-cash, there's nothing cash about depreciation. It's a non-cash expense, reducing the value of an asset over its useful life. And there's another typo, sorry about that. I saw all these this morning and I thought this is terrible. So it should be no apostrophe. So it's reducing the value of an asset over the asset's useful life. Now, useful life to who? To everybody? To it in general? No, it's just to the business. The useful life to the business. All we're doing with depreciation, we're taking the cost, we're saying, how long are we going to use this asset for? How long is it going to be useful to us? Okay, well, let's split that cost up over that useful life. Okay, and we try and say it's due to expected wear and tear, the age, the expected usage, technical and commercial obsolescence, legal or other limits, and we try and say that it's we'd like to acknowledge those items in depreciation, but really it comes down to an estimate of allocating that cost over its useful life. So we call that allocated cost, we call it a depreciable value, because there are generally two components in a depreciable value, and they're in the formulae that I'll go through next. And that depreciable value is apportioned over the expected useful life. Okay, there was something else I wanted to mention, but I've forgotten it. It's all right, I'll remember as we go through, I'm sure. Okay, so some terms that we'd like you to think about and tell us about when you're writing step 10 are the concepts we've just been introduced to. So the useful life, okay? There might be an asset, we'll use a machine or a vehicle. Actually, let's take a vehicle. So you buy your car and you use your car for 5 years and then you sell it on. That doesn't mean that the useful life of the car is 5 years all up. The useful life of that car might be 20 years. But to you, the useful life of that car was only 5 years because you only used it for the 5 years and then you moved it on. That's all we look at when we talk about depreciation. So depreciation is just the useful life to the business. Okay, even though that asset might actually have a longer useful life, we only take the portion in our calculations that's for the business. Okay, so the time period over which the depreciable asset is expected to be used by that business, even though the useful life may be 10 years. So I remember in this unit when we used to have very technical, more technical exams, one of the questions used to be the machine's useful life has, machine has a expected life of 30 years. However, the business will only use this machine for 10 years. So in your calculations, you would have to remember the useful life is 10 years, not the 30 years. It's the useful life to the particular business. Okay, so that's a very central concept. We talk about useful life, and in one of the methods is units of production. So we talk about the useful life being a number of production units expected to be generated by the asset. So again, a vehicle might be able to give 300,000 kilometres, but to the business may only drive that vehicle up to 100,000 and then move it on. So the useful units of production, or the number of production units for the asset to be depreciated, would be the 100,000 kilometres. Okay, so we look at the usefulness to the business in this first concept. The depreciable amount has two components to it. It usually has the cost, so the historical cost. Then we have a residual value. Now we came across the concept of residual value in 11059, so ACT 11059, where we looked at doing a capital asset scenario. And in some of those capital asset scenarios, we had to do certain calculations. You looked at including a residual value. That residual value was how much you thought you could sell that particular asset for at the end of its useful life. So if you can sell that car for a certain amount at the end of the 5 years, that's what we call the residual value. Okay, so we don't depreciate the residual value because we're actually going to be paid that. We take it off the cost. So the depreciable amount is what we paid for the car minus what we think we're going to sell the car for at the end of its useful life. The difference is what we call a depreciable amount. That's the amount of the cost of that asset to our business that we want to allocate over its useful life. Okay, so residual value is the estimated value of the asset at the end of its useful life. This is a very key slide, so don't lose it. You can memorise it if you like to. The journal for depreciation will not change. You need to create 3 journals in your step 10. Don't forget that section. Okay, so sometimes when we're marking the submissions, we find that students forget about this section. You have to provide us with at least 3 depreciation general journal entries that are relevant to your firm, and you have to tell us how you derive them and so forth, and the consequence of them and how they flow through the financial statements. The journal doesn't change, so it's a fairly easy journal to remember. It's debit depreciation expense and credit accumulated depreciation. Okay, and all we're doing with this general journal, literally, is moving an amount from an asset to an expense. You're moving that portion of the asset off your balance sheet onto your income statement. That's all this journal entry does. Okay, and how you move it off the balance sheet is through that contra account of accumulated depreciation. So you don't actually touch the cost, you sit it there as a contra asset underneath called accumulated depreciation. So that contra, or opposite to, sits there as a credit amount to take off the debit cost of the asset on the balance sheet. And you're taking that cost off, so you're crediting it there, and you are debiting it to the profit and loss statement, to the income statement as an expense. That literally is this journal entry, and that is the depreciation expense for the year. What will change is the figure, and depending on which method for depreciation will determine different methods and different figures which get transferred, and also the actual contra account that it sits in. Okay, some firms actually have individual depreciation expense accounts for individual assets as well. That's fine. So they might say depreciation expense machinery, depreciation expense vehicle, and so forth. That's fine too. Most firms that I deal with just lump all of their depreciation into one expense account, but they have separate contra asset accounts for each item of property, plant and equipment, or each item of depreciable asset, essentially. So they'll have accumulated depreciation machinery, accumulated depreciation buildings, accumulated depreciation vehicles, and so forth. Okay, and they'll lump it all. It doesn't matter. The important point out of this slide is that you are crediting the balance sheet and you are debiting the income statement. Okay, we are moving that cost. We are allocating the cost to an expense in order to adhere to the matching principle. That's it. So debit, depreciation expense, credit, accumulated depreciation. Okay, now I referred to this slide earlier and I said I was going to come back to it. Here I am, I'm back to it again. Land, you notice we didn't put any contra asset account. And that's because generally we don't expect land to go down in value. So we don't depreciate land, we don't allocate its cost. But we do expect buildings and pretty much everything else. I think Martin in the study guide, when he's covering it here, says, like everything else, with the usual exception of land, all items of property, plant and equipment are expected not to last forever and eventually wear out. Like most things in the world, including even our own bodies, sadly. I thought that was quite funny. Anyway, so generally we won't depreciate land, but we will depreciate buildings and equipment and a lot of other non-current assets. And we put the contra account, the credit contra or opposite account, directly underneath it. Now this is the disclosure, but you'll notice that many of your general purpose financial statements don't even have this level of disclosure. They will put all of this in the notes. So when I went to Wesfarmers, they just had one line for property, plant and equipment. They didn't even put this separation on the balance sheet. They've taken it right off. They've literally just put two lines, one for property, one for plant and equipment. So here they've got property, they've got plant and equipment, and then two figures. And if I want more detail or more disclosure, I have to go to note 7. So if I scroll down till I get to note 7, I have a look and I can see, oh yes, here they go. They've actually split them up for me. So property, they've got land, and notice they're not depreciating their land. They've just got the land at cost. And then they've got buildings, and they are depreciating their buildings. So they've got two amounts there. So at the end of the year, those two amounts added up together, the 1142 and the 778. Let's just check. Get my calculator out. 1142 plus 778. It's 1920. So that should be the amount that they've reported for property on my balance sheet. And same thing for plant. If I want more disclosure of what this 6488 figure is, go to note 7 and add up this. So see, they've got a heading for plant and equipment, and they've split them into leasehold improvements, plant vehicles and equipment, and mineral lease and development. And they've got 3 totals here, which I'm pretty sure if I add those 3 amounts up, they would add to the 6488. Okay, so a lot of companies won't, especially in general purpose financial reports, they won't even have this disclosure in the financial statements. They'll put that in the notes section. Okay, so on the financial statements, on the balance sheet, they will literally just have 1 or 2, in Wesfarmers' case, 2 lines with the net value. In special purposed financial reports, however, which generally don't have to adhere to the accounting standards because they're special purpose, so they're usually internal reports that you prepare for management, they're more common. I see this split up on the actual balance sheet more commonly because internal users generally don't like to look through notes and notes of information. They don't have the time. They just need to see a very succinct report, so they just want to see on one page what is the general split up. So this is more common on specific purpose financial reports. All of your companies reporting in general purpose financial statements, okay, because they are reporting entities, and we looked at that previously. So most of the disclosure in your companies will be the same as Wesfarmers. There would literally just be 1 or 2 lines, and then for more disclosure, you will need to go to the notes. Now, let's look at 3 of the more common depreciation methods. So we have straight line, diminishing or reducing balance, and units of production. The reason there's 2 different names, well, like a lot of things in accounting, there's so many different terms for the same thing. Like, why don't we just have one term for it? I don't know. We generally have a lot of different things, a lot of different terms for one concept. But generally, my understanding is, so straight line and prime cost, they're generally the same thing. One's just used more commonly in accounting depreciation versus taxation depreciation. Okay, so for tax purposes, usually the taxation regulatory body will issue, this is what you actually can claim for taxation, which is often different to what you record for depreciation for accounting purposes. Okay, so generally most companies will have 2 asset registers, one for taxation, one for accounting. And so again, the distinguishing in terms between straight line versus prime cost is simply just for that reason. One's an accounting method, one's a taxation method. The actual process of how you calculate it is the same. So it's just a difference in terminology. So again, diminishing value or reducing balance method, so DV, diminishing value, reducing balance, RV method. Again, the concept is the same, just whether it's used in accounting versus taxation. And units of production method. The reason that we call them these is if we were to graph the depreciation, the graphs would look like a straight line for this method, a diminishing line for this method, and then reflecting actual use for that method. So if I just, I'm gonna draw again because you know I like drawing. I'm so good at drawing. I should be an artist. My dad is actually. I'm not as good as he is. All right. So if we were to, let's just say, actually I'll draw a big, huge graph. So if we were to put, say, depreciation, the dollar value of depreciation, and then let's call it years. I should actually call it time. So year 1, year 2, year 3, year 4, and so forth. So if we were to graph depreciation every year, depending on which method we used, when we do the straight line method, we literally would, so the straight line method calculates the same amount of depreciation over the useful life. So it's the same amount every year. So we'd have in year 1, we'd have this amount, year 2, we'd have this amount, year 3, we'd have this amount. So we end up with a straight line, and that's why we call it the straight line method. The diminishing value method generally allocates a higher amount of depreciation in the first year. So we'd have like a higher amount here, and then the next year it would be lower and then lower. So you generally have a line that looks like that. So hence why we call it the diminishing value or reducing balance method. And the units of production is, I guess, trying to align it to the actual use in reality. So depending on how much you drive your vehicle or use your machine, you might go like this, you might go like this. It tries to reflect generally how you use the machine in the real world. So that's just a bit of information about the names of these. So straight line results in even depreciation every year. Diminishing balance, more at the beginning and less at the end. And units of production reflecting reality, hopefully, or more aligned to reflecting reality. So, starting with the straight line method, it's perhaps the most simplest to calculate. It allocates an equal amount of depreciation to each period of the asset's useful life. So we talk about having a depreciable amount here. Now remember, there are 2 components to that depreciable amount. There is the cost and there is the residual value. So in here, you could replace the word depreciable amount with cost minus residual value. So cost minus residual value equals your depreciable amount. That's the amount that it's going to cost the business to have that asset and use it in generating its revenues for a particular period. That's the amount of cost we want to record and depreciate or transfer to the income statement every year. So depreciable amount divided by however many years we think we're going to use this particular asset for tells us how much we can depreciate every year, or how much to put into that journal entry. So for example, let's just assume, and here again is another typo, I'm really sorry, this should be all underlined. So where it says depreciable, that should be underlined. because it's dividing. So depreciation amount divided by useful life. So we've acquired a machine for $35,000, and it just happened to be right at the beginning of the financial year. The residual value, so what we think we could sell that machine for at the end of its useful life of 6 years, would be $5,000. So we don't want to depreciate the $5,000. So the depreciable amount is the cost, $35,000, minus the $5,000, divided by the 6 years that we think we're going to use this machine. So put it into our formula here, and it tells us it's $5,000 per year. Now, I just want to make a mention. We've assumed that we acquired this machine at the 1st of July and that our financial year ends on the 30th of June. Okay, so this depreciation amount that we've calculated is for the whole year. If you are calculating depreciation for part way through the year, you simply apportion the full year by the amount of time. So if you are doing depreciation on a month-by-month basis, you would divide the $5,000 by 12. So you get it per month, and then you could depreciate on a monthly basis. If you depreciate daily, you would divide it by 365 or 366 if you're in a leap year, and then you would depreciate every day. So just bear in mind, this figure that we've calculated is for the full financial year, just to make life easy with introducing these concepts. Okay, so the $5,000 per year, we've said every year now we're going to depreciate, put into our journal entry, $5,000. Nice and easy. Debit, depreciation expense, $5,000. Credit, accumulated depreciation from the machine, $5,000 at the end of the financial year. And we're going to put a little narration that says depreciation expense for the year. Okay, so fairly straightforward, fingers crossed. So you'll have to do these journal entries, all right? You'll have to tell me tell your markers how you have arrived at them, and explain how you've got them, and again, explain the effect of them. So where does depreciation expense go? It goes onto the income statement, which reduces profit, blah, blah. So again, accumulated depreciation is our contra asset account sitting on our balance sheet, which reduces the value of the asset. So we have our asset sitting there at cost, less accumulated depreciation to get to the net book value, or the written down book value, it's commonly called. So that was the straight line method. Now we get to the reducing balance method. Okay, so we're looking at the graph which starts at the top and then declines over time. Diminishing value or reducing balance method. It allocates a decreasing depreciation amount over the useful life of the asset. It assumes, the reason we use this method is we assume that the asset is going to be more productive in earlier years, and therefore we are consuming its benefits earlier. So we are transferring more of the asset's cost to an expense in the earlier years. So eventually we have a graph that diminishes in time. So the balance will eventually diminish in time. We call it diminishing balance because we apply the percentage rate to the diminished balance. Okay, so this one, there's a few little pointers I'll point out, particularly when we use non-current assets as an examinable topic. So this is the example. So again, on 1st of July, right at the beginning of the financial year, to make it nice and easy, assume that the machine has a cost of $33,000 net of GST, a residual value, what we think we can sell it for, of $3,000, and a useful life of 4 years. Now, there is a scary looking formula here. The good news is you don't need to know how to use the formula in the exam, okay? In fact, I'm pretty sure you'll never ever have to remember this formula again in your working lives, but just know that it is there, and this is how they derive the percentages. But in reality, you are given this percentage, okay? So the formula includes all of these aspects. It includes the cost, it includes the residual amount, it includes the useful life. Okay, so cost is C, R is the residual, and N for the useful life. So it actually includes all of that in its calculation to give you the percentage to apply to the diminished value. So all you need to know in terms of studying, again, is that you will be given the percentage method. And again, in reality, when you go out and you're processing depreciation in your firms, they will have set rates for accounting depreciation. So they'll have percentages you will have to use for that company when you process their accounting depreciation. And in Australia, the taxman has set specific percentages. Well, actually, they give you a useful life and you have a formula and you plug it in. But it essentially tells you a specific percentage to apply if you're using the diminishing value balance method. So you don't need to know the formula, is my point. What you do need to know is how to apply this percentage rate. So if you're given this question in an exam, you would say, the company would say, the question would say, the company uses the diminishing value or reducing balance method of accounting for depreciation with a rate of 45%. What you need to know to do is this 45% gets applied. So two tips. One, to the cost net of GST to start with, and two, to the reduced balance at the end of each period. Okay, that's what you need to apply this percentage to. So the common mistake I used to see in exams in previous years was students would take the residual value off the cost. So they would take the 33,000 minus the 3,000 and then apply the 45%. The formula in calculating this 45% has already taken into account that residual value. So don't double count it. You'll end up with a different figure. So just remember you're applying that percentage rate to the cost net of GST. So again, we don't include GST on our assets, on our property, plant, equipment. So anything we do is the cost net of GST. That's what we're referring to. So you're just applying that percentage to the cost. Don't take off the residual value again for this method. So you do take off the residual value for straight line and units and production. You don't in diminishing value or reducing balance because it's already been taken into account in deriving that percentage. So it's an important point I wanted to mention. So notice that to apply this 45%, we simply take the cost net of GST to start with for year one, multiply it by the 45%. That gives us the depreciation to put into that journal entry for year one. So the depreciation for year one is actually quite high. Now, to get our ending balance or our written down book value or our reduced balance at the end of the year, we take the depreciation away from the original cost net of GST. So the 33,000 less the depreciation for year one gives us what we call the written down book value or a carrying amount at the end of the year. That's the book that that's the value that we are carrying this asset, this machine at on our books at the end of the period. Okay, so now it's this reduced value or this diminished balance that we are now going to apply that 45% to for the next year. Okay, so you notice the reduced value is what we start with here. Multiply that by the 45% and that gives us the depreciation for the second year. So this is the amount we will put into our journal entry, so our debit depreciation, credit accumulated depreciation for the second year. Okay, so then, we take the 18,150 minus the depreciation for that year to get our new carrying amount at the end of the year. And again, we use that new reduced value to start year three with. Apply the 45%, get the depreciation for year three. Take that depreciation away from the reduced balance to get a new carrying amount for year four. That new reduced balance or the new diminishing balance 5490 becomes the opening carrying amount for the next year for year four. Multiply that by the percentage to get the depreciation for year four. So these amounts in the third column here, sorry, should actually be 1, 2, 3, 4, the fifth column. These are the amounts that we put into our journal entry. The debit depreciation, credit accumulated depreciation for every year. So you notice they've changed and notice that they are also reducing. So we're allocating a larger amount of the cost in year one, then year two, then year three, and a very small amount of that cost in year four. And then at the end of year four, because we said it has a useful life of 4 years, at the end of the 4 years, we're left with the residual amount, which we estimated we could sell it for and get it off our books. Okay, so that is diminishing value or reducing balance. Okay. So again, year one depreciation was the larger amount when we record it. And on our books, we would see the machine at 33 less the accumulated depreciation for year one. So that gives us our reduced balance. That was the amount we applied our 45% to for year two. Then for year two depreciation, it was only 8,000. This 8,000 here, we're accumulating it. It's going to get added to the first year's depreciation of 14. So on our books, we're now up to 23 odd thousand of accumulated depreciation. So our diminished value is now 9982. That's what we apply the 45% to determine depreciation for year three. So for year three, we record depreciation and so forth. Okay, so that's diminishing value method. The third main or commonly used method of depreciation is our units of production. Now this is where we try to estimate, or we calculate an amount and then we just apply it to the actual usage of that asset for the year. So it allocates a fixed amount of depreciation per unit of output. And common units of outputs are hours or kilometres or units. So the annual depreciation is again our depreciable amount. So exactly the same numerator in this formula as straight line method. So we start with cost minus residual value. So it's the same numerator on top as straight line method. What changes in this formula from the straight line method is the denominator, the bottom. In the straight line method, we divided by useful life to the business. In units of production method, we divided by the number of units that we think are going to be useful to the business. Okay, so we divide this annual depreciation, depreciable amount by the production capacity or useful life in units to the business. How many hours are we going to use this machine for? How many kilometres are we going to drive this vehicle for? Divide it by that total number and you will then get a depreciation amount per unit. That's not the amount you put into your general journal entry. There's one more step. Okay, with the straight line method, number one, we divided it and got a nice, neat, every year, this is the same amount of depreciation every year figure. With units of production, because we're dividing it per unit, you actually get a depreciation amount per unit. So every year or every period, if you do it every day or every month or every week, whatever it is, every period that you're depreciating, you have to actually go and get how many units did we use up physically? How many hours did this machine run for? How many kilometres did this vehicle drive? Look at the odometer difference. So you actually have to get, so one more step, you need to obtain the actual number of units that were used in the period. So we've got a dollar value per unit. Once we get the actual number of units, multiply the two together, and then that's the amount you can put in your journal entry. So, for example, we're going to assume that our machine of 33,000 net of GST and the residual value of 3,000 has a useful life of 15,000 hours. So our depreciable amount is still our cost minus residual. So it's our exclusive of GST cost of 33,000 minus the residual value of 3,000. So our depreciable amount is the 30,000 divided by 15,000 hours that we think this machine will be useful for our business. So it will run, we will use it for approximately 15,000 hours all up and then we'll get rid of it. So divide that 30,000 by the 15,000 hours will give us $2 per hour. So every time we run that machine for an hour, we need to allocate $2 of depreciation for that hour that's used. So let's just assume we use it for 5,000 hours this year. So we would times the $2 by the 5,000 hours and we will get depreciation dollar amount of $10,000. So the journal entry is still the same. The journal entry hasn't changed. Debit depreciation expense, credit accumulated depreciation. What has changed is the figure, the dollar amount. So we debit the $10,000, we credit the $10,000 to accumulated. And again, show our workings in our narration. So in an exam, if you get questions about depreciation and calculating your methods of depreciation, make sure you show your workings. Always show your workings. Okay, so going back to my lovely drawing, my artistic drawing here, we've got straight line method allocating depreciation over time. We've got diminishing value where we have initially a greater amount of depreciation and then a small amount. And then units of production which may vary depending on how we use it. Okay, so the point is regardless of where the graph goes in the meantime, we will still get to the same point, the same amount of depreciation. So at the end of the useful life, we will still have depreciated the same amount, okay? So we'll have a different depreciation expense each period, okay, depending on which method we choose. So every period will have a different amount. So again, flicking back, we got, you know, in the year one, we might have 3 different amounts in year one. But over the whole life of the asset, the depreciation should be the same because we are still allocating or depreciating that depreciable amount. And we can see that in the formulas, directly in all of their formulas. In straight line, we can see it's cost minus residual, same with units of production, cost minus residual divided by. With our diminishing balance, it's incorporated into our percentage. You can actually see that they're incorporating that residual on the cost into the formula. Okay, so over the whole life of that asset, total depreciation should remain the same. Okay, so which method do we use? Now, I love this topic. In Mackay, we always have a really nice discussion about which method we should choose and what methods some different companies have chosen and why, and potential reasons why. Because, you know, there's a lot of grey area in accounting, and this is one of the grey areas. So the choice of depreciation method should match consumption of benefits. But we've already discussed that what most people think of depreciation as wear and tear is not really what we do in accounting, because accounting is really just a systematic allocation of the cost over a useful life. It's literally just a journal entry and an estimate at that. So whilst we say the choice should match consumption of benefits, a lot of the time it doesn't. So if we're saying, so again, this is purely, you know, what we perhaps should be trying to do. If you think that this asset will help you generate revenue evenly, then you should perhaps choose the straight line method of depreciation, which allocates the expense evenly. If you like to try and match it more accurately to the usage of that actual machine, perhaps you might choose the units of production method. Or if you think that this asset will help to generate more revenue in the earlier years, then you should perhaps choose the reducing balance or diminishing value method. And I'm sure the teaching staff will love to have some conversations surrounding this concept in your workshops. So there's a lot of different reasons why different depreciation methods are chosen in reality. But generally, this is how we should be choosing them. Okay, some other issues. I am slowly chewing through my time. Depreciation, some other issues. So again, we've already highlighted that depreciation is an estimate. It's never really accurate, and it never usually does match with what actually happens with the wear and tear of the asset in reality. So to try and counteract that, there is provisions in the standards to say that we should revise our depreciation rates and methods on a regular basis. Okay, so depreciation is an estimate, it's rarely precise. The residual values and useful lives should be reviewed at least annually. And depreciation charges should be then adjusted over the remaining useful life. Okay, the accumulated depreciation does not represent cash. This is actually a common misconception, and it's not even a funny one. It's a little bit embarrassing when you sort of explain it, but there's a lot of times, you know, I'll be looking at a special purpose balance sheet with somebody managing a firm, and they will actually think that the contra asset account is sort of like a sinking fund, or it's sort of amount of cash that's put aside for the replacement of the asset. It so isn't. Okay, it literally is a contra asset. It's the portion of the cost that we've taken off the balance sheet and put across to the income statements. It's literally that simple. It's a journal entry. So trying to tell that to someone who is an accountant is sort of it's a bit harder to explain. So if your cost is $30,000 and you've got accumulated depreciation of $30,000, what we're saying in accounting terms is we've already allocated the cost of that asset as an expense over these years. And they say to me, well, that asset still exists, we're still using it. And then I say, oh, well, you might need to review your useful life. So the accumulated depreciation portion on your balance sheet really is just an allocation of the cost. It's an accounting journal entry that allocates the cost of the asset as an expense. It doesn't represent cash. There's nothing cash about depreciation. And it certainly doesn't represent a sinking fund or a replacement fund for that asset. Okay. Now, additional costs after acquisition. This is another grey area, and it's one that I particularly came to know quite well or deal a lot in when I was an auditor. Because one of my audit program costs would be to look at their repairs and maintenance general ledger account and see if there were any items that should be capitalised, and then again conversely look at their property, plant and equipment account, so all the entries that have gone in and out, and also the related accumulated depreciation, to see if there's any that should be expensed. So the big thing about whether we should expense an additional cost after acquisition. So we're spending money on this asset, not just when we first buy it, but afterwards. So you buy a car, right? So we've recorded the cost, we're depreciating it, whatever. Afterwards, you're driving the car and it needs a service. You have to take it in and give it a service and pay for that service. And a general service of my vehicle now, I don't know about your vehicle, is between $800 to $1,000. So, it's a fair, substantial amount. Do you expense that or do you capitalise it to the cost of your vehicle? Okay, most people say, oh, expense because that's what we do in practice. But really, if you think about it, it can be argued. The thin line or the dividing line is it going to extend its useful life? So is this service going to extend the useful life of my vehicle? Yes, no. If it isn't, then you expense it. If it is, then you capitalise it. So that's the theory. In reality, so a car's fairly easy to see. If you put it in for a service note, it is just going to maintain its current level to its current useful life. Probably isn't going to extend its useful life, so it's an expense. So your general services on your car are accepted to be an expense. But on larger assets, particularly mining assets, they're very large services which may have to occur at certain intervals. They also have machine overhauls. Now, I've learned from working again in practice, generally when they talk about an overhaul, it's extending a useful life. Not always. Some of the machine services or machine overhauls that have to be performed on these big, huge machines actually just maintain its existing current useful life. So they are expensed. And what I've found from working in practice is that sometimes managers don't like to expense particularly large amounts because it reduces profit. A lot of their remunerations are tied to profit. So they'll try and capitalise it and say, yeah, we're extending the useful life. So you can have some very interesting discussions, particularly when the figures are quite substantial. So you really have to look at the substance. Really, what is this overhaul for? Is it going to extend the useful life, or is it just maintaining the asset for continued use at its current useful life? Anyway, just another idea there. Very, very interesting in practical reality. So if it's maintains the asset at its current level, nice and easy, expense it. If it will extend its useful life, going to, give it a new engine, it's going to make it last for an extra 10 years, then we will capitalise it to its cost on the balance sheet. So again, need to consider the impact on the useful life and the future economic benefits, but in practice can be quite grey. And as an auditor, you can only access what you're told and what records they give you. So, it can be quite grey. Property and plant records. So we talk about asset registers, and there are so many different formats of these. So basically it's just a subsidiary ledger, which we talked about earlier this term. It's another little ledger off to the side, well, not little, usually they're very big, but it's another ledger, subsidiary ledger, which provides more information or additional amounts to one general ledger item. So in this case, property, plant and equipment. So we have asset registers which actually detail every single item of equipment, and they detail a lot of different information. So usually they'll divide them into different classes with separate account codes for each class or each group of asset. And then they'll have subsidiary ledgers even for an asset register for each class. And Common things that they'll put in asset registers are things like additions to that asset or disposals of that asset or parts of that asset. Any differences in depreciation, so you get tax depreciation and accounting depreciation. Often there'll be two different ledgers maintained, one for tax purposes, one for management purposes, which is the accounting depreciation. Some put insurance in there. Some put the adjusting entries, so the depreciation adjusting entries will be put in there. Lots of different bits of information can be included. And what I would suggest you do, and I just literally did a quick Google of it before class started, I went, show me an example of an asset register, enter, and like all these different lovely spreadsheets came up. And I had a look through some of them, and I think it's a good exercise you might like to include in your workshops today. Just do a quick Google and have a look at the common types of plant records that come up just on Google. Just bear in mind, obviously, they're coming from lots of different places around the world, so some might be a bit dodgy. But I've clicked into this one in particular and just brought it up. So just to give you an idea of some of the items or the bits of information that are kept. So they have an asset number in this case. They've got the date of purchase, the quantity of that particular asset, description of asset, the make and the model, serial number, the unit cost, any other bits of information they want. So in this case, they deem that an invoice number is important. The location of where the asset is kept, whether it's been disposed of, the quantity it's disposed, the reason for the disposal, and so forth. So this is obviously from a different country, but that's an example of an asset register that's actually used. So I'd like you to just have a quick Google, just see, it gives you a feel of what companies, different firms and entities, small entities that aren't even general purpose firms, such an example of what they sort of keep in terms of records for their particular assets. Okay. So asset registers. So again, I've pretty much explained that. Commonly accepted bits of information that are kept. Now, disclosure I've pretty much talked about already. For general purpose financial reports, you'll really only just get the one line or the two lines in Wesfarmers' case, and they would just put the net written down value or the net carrying value, and then they will give you this detail in the actual notes to the accounts, as Wesfarmers has done. But the important thing is they're classifying them as a non-current asset. Now, I mentioned earlier that we must initially record our assets at cost on our balance sheet, okay? And the cost included those three particular aspects. There is an option to revalue. Now, I think this study guide goes into quite, I like the way that Martin's explained this section in the study guide. So please make sure you're not replacing the study guide with just this lecture. Please read through the study guide. So on page 8, we go through the cost or revaluation models. And then in particular, with reference to the standard as well, there is a section on what we have to do when we revalue an asset. I'm going to run through very, very briefly the ins and outs, but this is all going to go in your head and you're going to forget it. So when you're taking the time to personalise it and internalise it and write about it as part of step 10 in your assignments, please take the time to read through the study guide and try and put your own experiences there as well. So under the revaluation model, we are allowed, so if we think worth the market value of an asset has increased over time, okay, so we bought land 20 years ago and it was $20,000 and now it's $100,000, we are allowed to value it up to that $100,000. Okay, and we are allowed to recognise that $80,000 value increase in our equity. But just where is what I'm going to cover now. So under the revaluation model, we can revalue it to its fair value. Okay, we can also revalue it down. So if we're carrying an asset at a higher value than what we can sell it for, or what we might be able to sell it for, we have to revalue it down to its recoverable amount, we call that. So it can be a revaluation increase or decrease. But if we do that, if we revalue either way, we have to apply it to the entire class of assets. That's what the standard says. We can't just pick and choose one particular motor vehicle and, value that up or value it down. We have to do it to all of the motor vehicles in that class. Okay, so we have to do it to the entire class. And there's a lot of other rules as well. If we're valuing it up, we don't include it in profit for the period, because then that would create lots of motivations for fluffing up our profit. So the increase we initially recognise in other comprehensive income as a value increase, and then we transfer it to an asset revaluation reserve or any sort of revaluation surplus account as part of the closing process, which Karen took us through back in weeks 2, 3 and 4. Okay, so the increase, so an initial revaluation increment, we call it, we recognise it in OCI, other comprehensive income. Okay, not in the profit, don't put it in as revenue. It goes into other comprehensive income, and then as part of our closing off process, we transfer that to a reserve in equity on our balance sheet. For depreciable assets, we write off depreciation before we revalue, and make sure that we, with all of our revaluations, make sure we are adhering to the prudence principle, which is part of our conceptual framework, which says anticipate all future losses, but don't be so hasty to anticipate future gains. Okay, we must only, it must be applied. So if we're going to revalue, we have to do it to the whole class of assets. We can only do it when the carrying amount exceeds fair value. Sorry, this is revaluing downwards. So if we've got something on our books, that's what we call the carrying value. If it's fair value, what we actually could get for that asset is lower. So if the fair value is lower, we must decrease that carrying value to that lower amount. It's kind of similar to the concept that we looked at in inventories, net realisable value. So if the lower of cost or net realisable value, it's sort of the same concept here. The carrying amount is greater than what we could actually sell it for and recover it, the recoverable amount, we need to value it down. Now, when we're valuing it down, because of that prudence principle, we have to recognise that as an expense, which is a bit funny because we don't get to recognise the increase as revenue. It has to go through other comprehensive income, then gets put as a reserve on the equity section. With a decrease, however, we're being prudent. We're going to show that straight as an expense, okay, which reduces profit. It's not a reduction in other comprehensive income, go straight onto the income statement. So that's a one pointer to point out with. The only exception is if we previously revalued it up, then we decrease whatever we revalued it up to, and then any extra goes to as an expense. Okay, so we decrease the asset revaluation reserve to the amount that we'd previously increased it, and then any extra decrease goes onto the income statement as an expense. But we've never revalued this before and we revalue it down, then it needs to go straight as an expense. Now, impairment came in 1st of January 2005 when we adopted the International Financial Reporting Standards, and it gave me a headache. I was working in audit at the time, and I've mentioned this before. But basically, there is a separate standard covering when assets are impaired. Okay, so when assets are impaired, the definition is where the carrying amount, is what our book value, what we're carrying them on our books, is greater than what we could recover them for or get if we sold them. So it exceeds the recoverable amount. We have an impairment of that asset. So we have to test for impairment. There are a number of factors which indicate when we have to test for impairment. And that was what gave me sort of grey hairs back in 2005. Anyway, so we have a number of tests. We test each asset for impairment. If we find that the carrying amount exceeds the recoverable amount, we have to impair that asset. We have to write it off. It results in an impairment loss or a revaluation decrease if we're accounting for the assets under the revaluation model. Okay, so we have to write them down. And impairment is a lovely topic. Now, intangible, I'll touch on impairment shortly when I talk about goodwill. Intangible assets are basically defined as not having a physical substance. They're not tangible. If they're identifiable, we can list them out as one of whatever they are. So usually patents, trademarks and brand names, we have to separate them according to their class. If it's unidentifiable, we just lump it in as goodwill. Okay, so we'll discuss goodwill briefly. We amortise intangible assets, which is essentially the same thing as depreciation. We just don't talk about depreciation with intangible assets. So amortisation is the allocation of depreciable amounts of intangibles to periods benefiting from their use. The method must reflect the pattern in which the asset's future economic benefits are consumed by the entity. There's no amortisation if an intangible asset has an indefinite life, so such as goodwill, we don't amortise goodwill. The useful life has to be reviewed each period, and you must test the asset for impairment each period. Okay, now goodwill has a specific accounting definition. They define it as future benefits from unidentifiable assets. Okay, it is a non-current asset, and only purchased goodwill can be recognised. So you can't say, oh, look, I think this year we've generated $1 billion of goodwill internally because we're such good salespeople and we look after our customers, and then just recognise $1 billion on your balance sheet. You can't recognise internally generated goodwill. Okay, it's too grey. But you are allowed to recognise purchased goodwill, which in my books is essentially the amount that you pay for a business more than the value of its assets. Okay, so it's just a journal entry. A lot of students, when we have this discussion, and we pick up on this in the workshop, because I really just briefly mention it here. It's not really something we focus on in this unit, but it generates a good discussion. So I usually ask the students, tell me what you think goodwill is, and then we have a look at really what in accounting it is. So in accounting, it's really just, again, a mathematical balancing debit-credit entry. Just like depreciation, allocating a cost, not really matching wear and tear. We record it at cost less accumulated impairment. So we don't amortise goodwill. We used to back in the day. We don't anymore. We just test it for impairment. Again, a very nice grey area and really, really interesting discussions. How do you impair goodwill? Okay, so some good topics you can pick up on and discuss in your workshops. So for me, goodwill is a very large portion of Wesfarmers' non-current assets. So I would write about that as part of my step 10. And I would look at why they have such a large amount of goodwill. Once I understand that goodwill is simply the balancing entry above, so what we've paid for it, minus the amount of assets that we get for in the business, what's the difference? We balance that difference to goodwill. So the credit entry is credit cash, or however you're paying with it, shares or whatever. So credit what we're paying, debit all the assets onto our balance sheet, credit the liabilities, so we get a net asset amount. And then what's the remaining debit? Oh, let's lump it to goodwill. Okay, enough about goodwill. I'll let you continue on in your tutorials about discussing those key concepts. But step 10, this is what I would like you to complete today as part of your tutorials very soon. Okay, so step 10 is essentially where we are asking you to describe to us about your firm's property, plant and equipment, and also to consider depreciation. Now, a lot of your firms may not depreciate or they may not show the amount of depreciation in their notes. Some will, as part of accumulated depreciation, but I have seen reports where there's basically nothing in there. If that's the case, that's fine. You just need to use your knowledge about depreciation and come up with something that's reasonable. And you know the structure because we've just been through it today. I'm just going to quickly, in the last couple of minutes, run through step 10. Okay, so we want you to describe your firm's depreciation policies and create some depreciation entries, okay? You have to read the study guide. You have to open up your firm's annual reports, okay? Have a look every year, not just in the latest year. We want you to look at every year. And as you're doing this, we want you to pick out all of the key concepts. Answer these questions, all right? We've given you some prompts to kind of guide your discussion back to us. And then use the information in your discussion to create your journal entries, at least 3 journal entries, and then tell us the effect on the financial statements. So that's step 10. This is what I'd like you to focus on, this step 10 in your workshops. All right? Now, we've got about 4 minutes remaining. And in this 4 minutes, I'd like to go to the minute paper so that you can briefly tell me your thoughts about what was the most important thing you learnt today, because there was a lot of information. I did tell you there was going to be a lot. And what questions do still remain unanswered. And I will time it because I'm on a timer. So it's 10:19. At 10:20, I'm going to have a look at your responses, please. And then that'll give me 3 minutes to cover your responses. Okay, a minute might have been too short. Anyway, it's 10:20 on my computer here now. So the most important thing that you learned today, there are many different ways to calculate depreciation, yes, and we went through 3 today. So you can choose whichever method you want to use in coming up with your depreciation journal entries for step 10. We learned how depreciation is a contra entry and has to be recorded twice in the balance sheet and income statement. Okay, this is important. So depreciation itself is not a contra entry. Depreciation is a journal entry. So it's the process of allocating the cost of an asset through a contra asset account to the income statement. So the contra asset account is accumulated depreciation. The expense account is depreciation expense, and they are two different terms. So that's another concept. So good. That was a very good comment, and something we might pick up in the workshops, talking about the difference between depreciation expense and credit accumulated depreciation. All right. What questions still remain unanswered? I haven't got any. Are there no questions? Everyone's raring to get to the workshop. We're going to cut out anyway in a couple of minutes. Look, I'm sure you've got questions. It is a very large topic. It's a very broad topic, and lots of cool concepts that we can really flesh out, particularly when you're writing about it in step 10. Okay, so we've given you some prompts in step 10 that you can consider, and hopefully that'll give you a good structure for you to base your written responses and hopefully make that learning journey personal for you and non-current assets. And that's it from me. So if there's no questions, John will see everybody next week. I'll still be here, but I'm not lecturing. John's taking our lecture next week. Then back to me again, I think, in week 10 for cash flows. So thank you very much.